The next theme is debt, and there's an excessive amount of debt in the system. We've seen the largest increase in debt in 50 years in the markets, to the point where there's $80 trillion of GDP in the global system, and debt is 3 times that level. Why is debt important? Well, it's important for 2 specific reasons. Firstly, marginal cost versus marginal gain. The amount of debt it's taking now for governments to create $1 of GDP is 3 times higher than it was just 10 years ago. $1 of debt created $1 of GDP 10 years ago. Now we're needing $3 and $4 of debt to create $1 of GDP. The second reason why debt is important is that what we see is that historically, financial crises have originated after big periods of debt increases. And we've seen 3 periods like that in the past. In the 1960s, 1970s, and 1980s, sub-Saharan African countries got into big debt, and so did South American countries. That ended in the Mexican crisis in 1991, where the peso devalued and Mexican banks came under extreme pressure between 1991 and 1994. The second big spurge in debt happened in the later 1990s. There, in particular, we saw Asian countries and companies take on a lot of debt, as well as certain European countries, most specifically Russia. 1998, we saw the Asian crisis unfold. It lasted to 2001. It was a big drama in world markets, but again, a function of excessive debt taking before that event unfolded. Then, of course, we had the GFC, 2008. That originated in Europe, with banks taking excessive lending and increasing the size of their balance sheet, as well as investment banks in the US. It led to a housing market crash, as well as, we know, a stock market correction. 3 major debt events. The point is, those debt events pale into insignificance relative to what we're seeing currently in markets. Then, of course, there's the Fed's balance sheet. The Fed has increased its balance sheet to $9 trillion. Now, that's an asset on their balance sheet. They've been buying bonds and other assets, mortgage-backed securities in the market. But we're asking ourselves the question, how does the Fed reverse the size of its balance sheet without affecting the market? It's got to find buyers for $9 trillion of investments. It owns 25% of the treasury market in the US currently.